Wait, is it really better to have a lower credit score and less money down than to have a higher credit score and more money down? Not quite. What you're seeing in the news is being a little misrepresented. So we're going to talk about it today, and we're going to break it down because this is a super hot topic. Let's start with who did this. The FHFA is the board that's over Fannie Mae and Freddie Mac, which are the two largest conventional lenders in the country. They make up about 60% of all loans made in the United States. What they did is they changed adjustments to interest rates for almost all borrowers. So when you get an interest rate, this is a very complex thing to price for us. It's a difficult question when someone says, hey, what's your rate today? It's not quite that simple. The way interest rates work is there are adjustments to interest rates for multiple factors across the loan. You have loan to value, credit score. Now you're going to have debt to income. So there's several factors that can go into what your interest rate actually is. What the FHFA actually did is they changed the adjustments for people with higher credit scores and more money down, and they changed the adjustments with people with lower credit scores and less money down. So it's still better to have a higher credit score and more money down for your interest rate on a mortgage. It's just not as much better as it used to be. The reason behind this is they're trying to promote affordable housing. And so what they're doing is they're essentially subsidizing lower credit scores with less money down with those with higher credit scores and more money down. So when does this happen? I've heard a lot of people say May 1st, this takes effect. We knew about this a long time ago. We've actually lobbied against this. There's still a lot of that ongoing. Several states have positioned to have these removed because the end effect is hindering home affordability for a lot of people. However, this is already baked in to the rate sheets that we have today. And it's been that way for 45 to 60 days as of the recording of this video on May 3rd. So what does this really mean for you? Well, if you're getting a government loan, it doesn't mean anything at all. Government loans were not impacted by this change. In fact, one of the most popular government loans, FHA, recently got an improvement. What we've seen recently is people that used to be a no-brainer to go conventional. People with credit scores, say, slightly over 700 with 10 to 20% down, might make more sense to look at FHA. FHA loans can sometimes have better interest rates, and then the recent improvement to the mortgage insurance on FHA loans makes them more attractive. So that's what's actually happening. It's not a fee that's being tacked onto your mortgage. It's not better to have a lower credit score and less money down. You're always better off having a higher credit score and more money down. I hope this helps.